Hello, D2, and welcome to our monthly Building Your Better Business webinar experience. I'd like to welcome you here as we do our last event for 2018. As you know, it has been a very tumultuous closing quarter to the year. The year started on great fanfare and hit new highs in January. And as of the taping of this, we've just come off of new lows for not only this year, but for the last 14 months. The byword has been volatility. One thing that we would caution you to watch is where you are exposed with your clients to high yield bonds, emerging market debt, other kind of leverage loan type assets. These would be in the BKLN, perhaps FLOT ETFs. Also, there's an EMB ETF, as well as the HYG ETF and numerous mutual funds to consider. Specifically speaking, it's been quite some time, over a decade, since we've had any real negative credit events or defaults out there. And we are taking a cautionary stance with our clients in that coming out of these potentially dangerous credit investments, we will hopefully be protecting them from any future defaults by going to safer treasury type investments. And if we're wrong, their stock market allocations should pick up the slack. And if we're right, having being moved to protective securities will actually hopefully pay off for them down the road. But without a doubt, the last month and a half to 2 months has been all about volatility. It appears the stock market doesn't have the optimism it once had, and now nearly almost on a daily basis, most of our rallies are sold into, and even days when we start with several hundred points jumps in the Dow or major advances in other indexes, we face kind of a mountain of sell-offs. I think it's important and more important than ever to reassess your client's real risk appetite, as well as where their need to income is. At this point, none of the what I would call boxes that need to be checked for recession have been checked. This yield curve inversion that happened with the 2-year and 5-year Treasury notes is typically not the real benchmark yield inversion that is watched. It's more like the 90-day Treasury to the 10-year T-bill. Probably the best place to look for this information is the Cleveland Federal Reserve's website. And we're still at a small but decent difference between those two proxies. As I've told many clients, this same thing happened in the 90s a few times, and the markets continued to kind of barrel on, but eventually a recession did occur. I think as we get ready to look at 2019, it's imperative that perhaps we look at this more a quarter at a time, and for your clients that are outside of 5 years of retirement, I don't want to say they don't have anything to worry about, but I would look at their situations much differently than those who are retired, because some of the demographics that have gone on, and the phenomenon in investor psychology I would call statement shock. Once all your clients become millionaires, even a 5-10% regular stock market correction is going to be several $100,000 or $1 million on their statement. So some of that needs to be talked through with the clients and worked through, as that can be what I would consider to be one of the big things that has to be managed through as being a financial advisor. But as we close the year, stay diversified, look at where risks might be hiding and haven't been triggered yet, and don't be afraid to discuss with your clients where they are from a risk appetite standpoint and if this volatility recently has been too much for them. Hello and welcome to our Dynamic Directions 2019 Market Outlook. These forecasts are about as good as what you can expect from your local weather professionals wherever you hang your hat, but we'll have it a go. Sometimes in Kentucky, they'll predict rain and it'll be sunny. They'll predict snow and it'll be the nicest day that we've had in 3 months. The same as it goes for your forecasters and weather, the same for it goes in your prognosticators here with the markets. Let's start off with one part of the market that we have really kind of missed on this year, and that's oil. Oil today, at the date of this taping, we're at about 46.77 on West Texas crude. It's down almost 6% today, 6 or 7%. Most of the information that we get for oil prices for the end of 2019 indicates somewhere between $65 to $82 a barrel for West Texas crude. Now, obviously, that's a pretty high watermark from where we are today, but we've seen a tremendous amount of price pressure since really the end of September, when that crude proxy was over $76 a barrel. So obviously that would indicate probably a little bit of an uptrend for crude oil prices. Let's talk about stocks. The median forecast we get for the S&P 500, and this is kind of a correlation between what Ameriprise says, Goldman Sachs, bank credit analyst, is somewhere between 2950 to right at 3,000 on the S&P. Given where we are today, that would be somewhere between a 12 to 15-16% total return over the next 12 months, and I would think that would be hopefully achievable. One thing that they do caution, and everybody's kind of on the same page, is continued volatility. They think we will continue to have market trading very similar to what we've had over the last 2 months. Now, that doesn't give anybody a restful night's sleep, but it's more important than ever to look at other asset classes just besides probably U.S. stocks. Let's look at bonds. The 10-year Treasury yield hit right at about 3.25 in October, and as of this taping, we're at 282. So obviously that's down about 43 basis points in 2 months. The standard prognostication for where the 10-year rate would be is about 3.5% by the end of next year. That's quite a ways from where we are now. And if it's like this year, there'll be kind of starts and fit to the 10-year. One thing that will be interesting, we'll get a Federal Reserve announcement tomorrow, but how many rate increases do we get? What once was considered a lock for at least 3 rate increases is now whittled all the way down to maybe 1 or none for next year, depending on how the economy goes, and that will yet to be seen. The one area that gets a lot of attention for a potential buying opportunity sometime next year would be the emerging markets. They have been beaten up now for over a year, and based on demographic trends and economics, a lot of money managers think that might be the next kind of hot spot. I would just recommend proceeding with caution in whatever you do, because the dollar still has remained strong, and people think we'll see dollar strength, but not perhaps as strong as what it has been. Typically, the emerging markets will trade opposite of what the dollar does, and so any dollar strength there would put a tremendous headwind in the face of the emerging markets. Within the U.S., what does better, which sector than others? We have been led for years by the high-tech sector and FANG stocks. Some of those stocks have lost their luster, especially in the last 60 days. I think the market is probably looking for other leadership, and it might be found in more mundane blue chip type stocks. Another area of the market that has been totally out of favor is financial stocks. I'm looking at some, now they are beaten down tremendously, and even the rate increases we had throughout the year did not help those proxy indexes. Healthcare had done well for most of 18. We've seen utilities pick up, but I would say stay diversified and be careful to watch you're not overweighted in any one sector within the U.S. economy. In a much bigger picture, one thing to watch during 2019 is most of the forecasted recession bugs felt like the end of 19, first part of 2020 would be when a recession would hit. I would indicate maybe it's more important for us to not look here at home, but look at China to see for perhaps hints of what's to come for the market next year. If the stock market is in fact a forward discounting mechanism, perhaps what they're already pricing in is that China will in fact supersede the U.S. as the world's largest economy sooner than later, and more of our stock price action here will be dictated on what's going on in the People's Republic. That's just a Drew Watson theory, but I'm asking you to watch that over the coming year or two and let me know what you think about it. But one thing's for sure, I think three things need to happen before we get kind of an all-clear signal in U.S. markets. One, let's get a clear indicative path of what the Fed is going to do. I think probably the best case scenario for stocks is they let everybody know 2019 will be a year where they will go meeting to meeting and be data dependent on whether or not they raise rates and not set out on some predetermined course. I think that's important. Number two, I think what we have to see with U.S. and Chinese relations, especially on trade, is something in writing. I think the days when our president could tweet that he's going to do this or that and the market would go up, and their premier or vice premier could say, hey, we're working together, we're working on it, we're going to knock these tariffs off and the market could go up, are over. In fact, in the last week and a half, we've seen factual evidence of a rollback in automobile tariffs and a large purchase of U.S. soybeans from China not do anything to dissuade the negative sentiment in the U.S. markets. So I think the market's telling us we need to have something in writing. I think the wild card is stimulus. And I'll go to the point I made before kind of our countdown here. It may not have to be necessarily an infrastructure plan of spending in the U.S. that comes out of our Congress. I think a massive Chinese stimulus package could do enough to dissuade global growth slowdown worries to perhaps push our markets higher. So I think those are the three most important things that we can look forward to in 2019. I think another kind of sidecar to this is what goes on in Europe. Everything in Europe has tended to be frozen with the Brexit negotiations. Theresa May has survived one vote of no confidence. It looks like, from her own party, by the way. And it looks like that the Labour Party, that's opposition to her conservative Tories, will plan another vote of no confidence. And the Brexit date just keeps getting kicked down the road like an old can. This will put a pall probably over most of what goes on in Europe until a deal is struck and they see kind of where they stand with that. So with that said, have a great 2019. Be sure to use us as a resource. We have every other week typically long investment calls. If you'd like to get on those, just contact Jacqueline at D2. She can give you our dial-in info. And I think 2019 may be the year of the dragon or the chicken or the rooster, but it's not the year of the turkey, which is good because it's not good to be a turkey this close to Christmas. Thank you, and have a great year.